Hey folks, welcome to a product review at Finominal. Today we're going to analyze one of the most well-known funds out of the UK, Fundsmith Equity Fund. Now this fund manages around 22 billion pounds of assets, and it's run by a very well-known fund manager, Terry Smith, and represents a highly concentrated portfolio of 25 to 35 kind of large cap, high quality growth stocks. Now, let's investigate what makes this fund so successful. And we're going to kick off with a benchmark exercise. Now, the fund manager in his documentation effectively makes the point that they are almost benchmark agnostic. Having said that, they do feature the MSCI World in their documentation. And we're also going to use that because although this fund is run out of as a UK fund, it does include its fair share of global equities. Now, if you look at the performance since its inception 2011, you can see this Fundsmith Equity Fund has done phenomenal, right? It has outperformed the MSCI World and also like a UK index, like in this case, the MSCI UK Growth Net Index. Now, that's from performance perspective, and that's naturally what makes this fund so successful in the sense that it has to deliver greater returns. Let's have a quick look in terms of what we learn in terms of factor exposures, in terms of what the style is of the fund manager. And so what we do see is, first of all, on an asset class level, we do see there's a consistent exposure to US dollar. And that's simply because this is a UK fund and it holds US denominated stocks, right? And therefore you have foreign currency exposure from a UK perspective. You also do see the equity exposures over time. And what you can see here is effectively consistent, well, almost consistently positive exposure to the low volatility and quality factors. You do see that the exposure to momentum and size is kind of like sometimes positive, sometimes negative, but there's also consistently negative exposure to the value factor. And that's as expected because the portfolio is comprised of these kind of blue chip, kind of like companies like Microsoft, L'Oreal, Novo Nordisk, Meta, that are kind of all high growth and high quality. Now, that's from a factor exposure perspective. So the style of investing has been relatively consistent over time, which is good in the sense that you kind of see the consistency there. We can also look at the alpha the fund manager has generated. And we already saw that the outperformance compared to the MSCI World was quite large. We can see that's 11 out of 15 years. We can see the alpha consistency is 11 out of 14 years, which is great. Very high active share at 87%, which is explained by this very concentrated portfolio. You do see also that the regression we're doing effectively has a relatively low R squared, and that's because with such a concentrated portfolio of 30 stocks, you do have a lot of firm risk rather than systematic risk. Now, the upside of that is that the alpha generation has been quite large over time, right? We cannot explain the outperformance very well, right? We do see certain factors contributed, but a large part of it is just stock selection. And so this is great in terms of for this fund on a standalone basis. Let's have a quick look in terms of how this compares to its peers. Now, we selected three kind of global equities, two funds and one ETF and then the benchmark index. And let's kick off with seeing how similar the current portfolios of effectively this Fundsmith Equity Fund is, as well as its peers. And again, we're going to switch to the MSCI World index. And what we see over here is these style boxes where at the center you can see the MSCI World from a valuation, market cap perspective, growth, momentum, volatility, and quality. we can see that these funds we selected, the fund from Scottish Widows, Aviva, and Amundi, actually one from Scottish Widows is not showing because there's no data on the underlying holdings. But at least for Aviva and Amundi, right, and the Fundsmith one, they're very similar from a market cap perspective. It's large caps, expensive large caps. From a growth perspective, they don't differentiate themselves much from an MSCI World. We can see they're slightly high momentum, a little bit less volatile than the average stock in the MSCI World. But the big differentiation is on quality, and not so much from a leverage perspective, but from profitability. And we can see here, this is the only kind of metric where the Fundsmith equity portfolio differentiates itself in the sense that it has the average stock has a higher profitability than its peers or the MSCI World. But overall, as you can see, right, most of those dots are in the same area, meaning that these are peers that kind of make sense. We can also look at these funds from a sector perspective. And if we scroll down here, we can, not sector perspective, we'll get to that in a second. The only other point is from a risk and return perspective, we'll talk about performance shortly, but we can see that effectively they kind of cluster around the same levels of volatility. Also from a return perspective, you can see the Fundsmith equity fund is right in the middle of here, like with a volatility of 15.5% and kind of like a CAGR roughly around 10% over the last 7 years. Before we move on to performance, let's have a quick look at the sector exposures, because here again we do see some meaningful differences. So we see that Fundsmith equity fund has an overweight to consumer staples and to healthcare compared to its peers and also the benchmark, i.e. the MSCI World Equities Index. And I mean, we have to recall that this is a very concentrated portfolio of stocks with 30 names. So even a couple of stocks, right, lead to large over and underweights. In this case, I think with regards to consumer staples, we see names like L'Oreal, which is sure to describe it, effectively the company that sells shampoos and lipstick and makeup and things like that, right? Having a large weight in the fund, as well as on the healthcare side, there's an almost 9.9% stake in Novo Nordisk, which is one of the companies that is producing these anti-obesity drugs. I think it might be Ozempic. And that's also, I think, the maximum this fund can hold, and it's 9.9% because the structure is UCITS fund. And so you do have this overweight to healthcare and consumer staples. Now, to the final topic in terms of performance, we already had a look at the performance of the Fundsmith equity product since 2011, its inception. And we saw that there is a stellar long-term track record. If you compare it to the performance of these peers and the MSCI World over since 2018, because I think one of these products only got launched at point, we do actually see much less outperformance. So you can see the Fundsmith equity product is kind of right in the middle of there. It actually has achieved the same return as that MSCI World index, right? And so the other ones, like this product from Amundi, the Global Titans 50, have actually outperformed the product. So we then need to differentiate, right, the track record of the Fundsmith equity fund in terms of the long-term track record versus the most recent one. We can also look at the Sharpe ratios, where effectively the Fundsmith equity fund does not differentiate itself, kind of like has a similar CAGR, some volatility. Sharpe is right in the middle of the other products, but the costs are on the higher side. So for example, you could buy the ETF from Amundi, which is these Global Titans ETFs, for 40 basis points versus 94 for the Fundsmith product, or you can simply buy the MSCI World at 15 basis points. And so this kind of concludes our analysis of the Fundsmith equity fund, which is mentioned as one of the one of the most popular funds in the UK. It is very concentrated, which is good because it's the kind of like the only possibility of a fund, one of the best ways of a fund to differentiate itself, right? It has a very high tracking error compared to the MSCI World or other indices. Having said that, the question does come up if we are looking at survivorship bias. And that's simply because if you imagine all of the funds that got launched in 2011, most of them would have liquidated by now because most fund managers do not outperform. And we can see that in the first few years, this fund has done phenomenally. But over the last, what is it, 6 years almost by now, there's no outperformance. And so the question is, right, is it luck rather than skill? Because the portfolio today is not that differentiated. Um, and that's something worth keeping in the back of our minds when we look at this fund, right? That yes, initially there was a strong outperformance, but that has basically been lost over the last few years. Hope that helps with regards to this fund. Have a nice day.